A faltól való elválás pillanatát, hogyha nézzük, akkor ott a centeres differencia módszer a legpontosabb. A második helyzet az a centeres differencia módszer a csillapítással, és az összes többi módszer pontatlanabb, főleg az implicit módszer pontatlanabbak lesznek. Hogyha a sebességeket ábrázoljuk egy grafikonon, akkor nem nagyon lehet látni a sok görbétől semmit, de ha ezt a részt kinyitjuk, akkor lehet látni, hogy itt eléggé pontos megoldást ad megint a centeres differencia módszer, főleg, hogyha csillapított centeres differencia módszer van, akkor még oszcillációsan nagyon lép fel. Az implicit módszerek, kék, zöld és a lila, azok elég távol állnak az exakt megoldástól, a többi megoldás pedig oszcillál. Hogyha most kinyitjuk ezt a részét a sebességnek, akkor azt lehet látni, hogy itt a sárga színű görbe, azaz a csillapított centeres differencia módszer modellredukció nélkül lesz talán a legkeskenyebb, azaz azt lehet mondani, hogy ez az, ami legpontosabban megközelíti itt az analitikus megoldást. Ha az energiadisszipációt hasonlítjuk össze, akkor lehet látni, hogy legnagyobb érték az implicit Euler módszernél van, aztán a Newmark módszer, a HHT alfánál a paramétereket úgy próbáltam beállítani, hogy a legjobb megoldást adja, és itt kisebb lesz már a numerikus disszipáció, és annál a módszernél, amit én alkalmaztam, a centeres differencia módszer csillapítással lesz a legkisebb a disszipáció. Itt igazából két görbe, a sárga és a kék színű van, ugyanis a modellredukció és a modellredukció nélküli megoldásnál is ugyanannyi disszipáció lépett fel. És itt fönt pedig azok a megoldások vannak, ahol nincsen numerikus disszipáció, ez a centeres differencia módszer vagy az exakt megoldás. A megoldások jóságának jellemzéséhez két mennyiséget fogunk használni. Az egyik az a teljes variáció, a másik pedig a relatív hiba az exakt megoldáshoz képest. A teljes variáció azt jellemzi, hogy a megoldás mennyire oszcillál. Itt az első helyzet a Euler módszer, ezek lehet látni, itt a legkisebb az oszcilláció, bár nem nagy a különbség, és a második helyzet pedig a csillapított centeres differencia módszer lesz. Az utolsó diagramon pedig a teljes energia megváltozását lehet látni, hát itt a Euler módszer a vesztes, hát ott változik legjobban az energia, ott disszipálódik el a legtöbb energia, és a centeres differencia módszer csillapítás mátrixal pedig egész jó helyen végzett. Relatív hibában az explicit módszerek a legjobbak. A centeres differencia módszer, főleg, hogy csillapítjuk, akkor a sebességnél elég kicsi értéket lehet kapni hibára, de az implicit módszerekkel összehasonlítva a csillapított változat a centeres differencia módszernek az nagyon jónak mondható. Az utolsó grafikon a szántáshoz szükséges időt mutatja másodpercben. A centeres differencia módszer itt is első helyen van, és alig van különbség a csillapított változat és a csillapítatlan változat között. Az implicit módszer az numerikusan stabil, azaz bármilyen időlépést választva működik. Azt lehetne gondolni, hogy lehetne nagyobb időlépést is használni, és akkor gyorsabban működne ez a módszer, gyorsabb lenne. Ábrázoltam a HHT alfa módszer esetén és a sebességnél, hogy mekkora relatív hibát követünk el, hogyha különböző nagyságú időlépéseket használunk. És lehet látni, hogy van egy olyan időlépés érték, aminél a hiba legkisebb lesz, és előtte-után is növekszik, és ez a piros ponttal jelölt időlépés nagyság, ez pontosan a centeres differencia módszer legnagyobb időlépését, legnagyobb lehetséges időlépését jelenti. Tehát igazából nem érdemes kihasználni azt, hogy a implicit módszerekkel gyorsabban is lehetne számolni, mert az eredményünk az jóval pontatlanabb lesz. Következtetésként azt mondhatjuk el, hogy az általunk javasolt új módszernél, amellett, hogy a teljes variáció értéke kicsi maradt, kisebb, mint az implicit módszereknél, a relatív hiba sem növekedett, tehát egy elég hatékony módszerről van szó, és ráadásul azt is mondhatjuk, hogy a sebessége ennek a módszernek jóval kedvező volt, egy gyorsabb volt, mint a többi módszer. A kutatás további iránya az lesz, hogy megpróbáljuk megvizsgálni kétdimenziós feladatok esetében, hogy ez a módszer mennyire hatékony. Hát ez kétdimenziós feladatokat már lehet akár egyszerű ipari feladatok megoldásra is alkalmazni, és esetleg a pontosság egy kicsit romlik, viszont a futási idő az jelentősebben javulhat.
Köszönjük szépen az előadást. Jelen vannak az előadók is, tehát kérem szépen, akinek kérdése van, az jelezze.
Én Péter szeretnék egy megjegyzést tenni, és meg egyet kérdezni.
Igen.
Tehát először is a megjegyzés az, hogy talán nem hangzott el az előadás elején, ez az átka ennek a videós felvételnek, hogy más helyzetben van. Tehát az, hogy a Balázs nem jelezte azt, hogy ez egy nagyon rövid idejű mini projekt volt, tehát ők nagyon 5-6 hónapra kaptak, csak úgy sikerült megszerezni a támogatást, és ezért jutottak csak el szerintem a numerikus modell részéig, annak az elejéig, és nem sikerült, hát nem lett még kifejtve addig, hogy az ipari feladatig eljussanak. Ugye Balázs, javíts ki, hogyha rosszul mondom.
Igen, tehát mi egy éve foglalkozunk körülbelül ezzel, úgy intenzíven, és hát a következő lépés lenne az, amikor kérdésfeladatnál már tényleg egy egyszerű ipari feladatra ezt ki lehetne próbálni.
És mi volt az a feladat, amire az Audi azt mondta, hogy az már őket érdekelné, hogy mert kaptatok tőlük támogató levelet?
Igen, hát konkrét feladat még nem volt, de vannak nekik ilyen feladataik, és hogyha sikerül odaig eljutunk, hogy tudunk ezzel érdemben foglalkozni, akkor fognak adni majd. Tehát még igazából kicsit az elején tartunk.
Köszönöm a kérdést, én is pont ezt akartam kérdezni. Van-e további kérdés?
Én kérdeznék, ha lehet. Én nagyon szerettem az ilyen egyszerű kis demo feladatokat, tehát például irányítás elméletben, az oktatás területén ezek roppant hasznosak. Nagyon szép a feladat maga. Az volna a kérdésem, hogy amit én nem teljesen értettem, hogy maga a fizikai jelenség milyen, tehát ezek az oszcillációk, ezek miért a módszertől függenek, miért nem magától a jelenségtől. Tehát ha elég nagy sebességgel ütközik egy rúd egy merev felületbe, akkor az oszcillálni fog, amikor visszapattan. Tehát mondjuk egy csőbe lejtek nagy sebességgel egy rudat, az nem fog abba a csőbe zavartalanul visszamenni, mert oldalirányú rezgései lesznek. Nem tudom, hogy ezt vizsgáltátok-e.
Tehát mi az analitikus megoldást vizsgáltuk, az analitikus megoldásban nincsen rezgés. A valóságban lehetséges, mert ott van súrlódás, a csőnek van valamilyen vastagsága, valamilyen átmérője, tehát ott lehetségesek olyan mozgások, ami egy rezgést kell, de hogyha tisztán csak egy egydimenziós feladatot nézzünk, és az analitikus megoldást, abban nincsen oszcilláció. És elvileg, hogyha mi ezt szeretnénk pontosan numerikusan megoldani, akkor kapunk jó numerikus megoldást, hogyha abban sincs oszcilláció. Viszont a térbeli diszkretizáció okozza oszcillációt, mert mi kiveszünk onnan, tehát akkor lehetne ezt pontosan számolni, hogyha a szerkezetnek végtelen szabadsági foka lenne, tehát végtelen sok saját frekvenciánk lenne, de nekünk most egy véges szabadságfokú rendszerünk van a végesen diszkretizáció miatt, és a magas frekvenciákat kivesszük a megoldásból. És ezeknek a hiánya okozza a rezgést. Ez úgy is szokták kijelzni, hogy gipszjelenség. Szakirodalomban így láttam ezt elnevezve. Tehát a térbeli diszkretizáció okozza azt, hogy itt oszcilláció van, és ezt valamiféle csillapítással lehet csak disszipációval lehet onnan eltüntetni. És ezt úgy kell megoldani, hogy a legoptimálisabb legyen, tehát a felhasznált disszipáció az csak a számukra kedvezőtlen oszcillációkat tüntesse el, és más ne. És ugye azt lehetett látni például az implicit módszereknél, hogy azok más is eltüntetnek, nem csak az oszcillációt. Tehát azok rontják is jelentősen a megoldást.
Köszönöm szépen, hát részben értem, de hogyha elég nagy sebességgel ütközik a rúd, azért az meg fog hajlani, nem?
Mi ettől megint eltekintettünk, tehát csak azt a feladatot vizsgáltuk, ami lineárisan rugalmas kisalkváltozásos feladatoknál. Talán ki is emeltem itt nem, de egy 8 oldalas összefoglalót írtam erről, ami szintén valahol elérhető lesz. És ez tehát csak lineárisan rugalmas feladatoknál, kis alakváltozások esetén vizsgáltuk most a megoldást. Kihajlás az már egy nagy alakváltozásos feladat lenne.
Köszönöm szépen.
Köszönjük szépen. Én úgy látom, hogy most nincsen több kérdés. Az időnek is nagyjából pontosan a végére értünk. Köszönöm szépen az előadóknak az előadásokat, a résztvevőknek a kérdéseket és a figyelmet. A szekció ezzel véget ért, most szünet következik, és 11 órakor fog folytatódni a konferencia a biztosítás és pénzügyi matematikai szekcióval. Tehát 11-ig most szünet következik.
speak Hungarian, please speak up. Miután nem hallok senkit, akkor itt a kezdeteknél mindenképpen talán mehet magyarul is a bemutatás, illetőleg a megnyitó. Mindenek előtt az itt lévők nem biztos, hogy mindannyian ismerik Horváth Zoltánt, aki a HU-MATHS-IN társaságnak az elnöke, és tehát őt szeretném bemutatni. Ő a társadalmi megnyitó. Ha nem hallok senkit, akkor itt a kezdetekben mindenképpen talán mehet magyarul is, és ez a bemutatás, illetőleg a megnyitó, vagy a hangját. Mindenek előtt az itt lévők, tehát hogy ez a Challenge Day tulajdonképpen arról szól, és azzal a célval hoztuk létre, hogy megismerjük azokat a kihívásokat, amelyeket bemutatni a partnereink, tehát a lehetséges üzleti partnereink, vagy ipari partnereink, ez most itt azért furcsa egy kicsit, hiszen bankokról és biztosítókról beszélünk, nevezzük így üzleti partnereknek az üzleti életben. Ez a Challenge Day, hogy ők igazából milyen matematikai kihívásokat látnak, megismerjük azokat a kihívásokat, olyan feladatokat, ahol a matematika a partnereink lehetséges hozzá tenni a üzleti feladat megoldásához, és elősegítheti azt, hogy biztosítókról beszélünk, gördülékenyebben, nagyobb hatásfokkal, adott esetben profitot generálva működjenek. Ezeket a kérdéseket szeretnék elsősorban megismerni, azért is, hogy a matematikai társaságban további terveibe tenni. De úgy gondolom, hogy erről az üzleti Horváth Zoltán megoldásra beszélni,
Üdvözlök mindenkit, Horváth Zoltán. Talán nem, nálam nem. Hallottok engem?
Igen, hallak. Ezeket a kérdéseket.
Oké. Akkor Laci, nálad van valahol hiba az éterben. Tehát szeretettel üdvözlök mindenkit. Laci, szerintem nálad megy a YouTube is. Üdvözlök mindenkit, Horváth Zoltán. Talán nem. Nem, nálam nem. Hallottok engem? Jó, köszönöm szépen. Szóval Horváth Zoltán vagyok Győrből. Talán emlékeztek rám, 16-ban is a legutóbbi pénzügyi szekciót pénteken tartottam. Is a szlájdjaimat, és először kezdem ezzel. Ha nem látszódna, akkor létszi szóljatok. Tehát mi ez a HU-MATHS-IN? Magyar, Ipari és Innovációs Matematikai Szolgáltatási Hálózat. Ez egy európai inspirációra jött létre, ezért is választottunk angol nevet, hogy a Hungarian Service Network of Mathematics for Industry and Innovation. Industry számunkra, meg ahogy a Laci mondta, minden, tehát a bankszektor, minden gazdasági szereplő az iparba tartozik. Ambiciózusan alakultunk meg 7 évvel ezelőtt, és elég aktívan tevékenykedünk az HU-MATHS-IN-ben, az európai szervezetben. Fő célja, hogy az ipar számára hasznosítható matematikai módszereket adjunk át, és szolgáltatásokat nyújtsunk az ipar számára matematikai módszerekkel. Jelenleg 7 egyetem és 2 Ötvös Loránd kutatóhálózathoz tartozó intézet Staki Rényi, 22 kutatócsoportja, mindegy 150 kutatóval tartozik a hálózatunkba. Ennek a 150 kutatónak több mint a fele aktív, erősen aktív. Vannak, akik mondjuk a mini projektjeink vagy rövidebb projektjeinkbe vesznek részt, de körülbelül olyan 100 emberrel van elég rendszeres kapcsolatunk. Ezeket egy EFO projektből támogattuk a tevékenységeink kialakulását, amely most március 31-én zárul. A nagy testvérünk az HU-MATHS-in 13-ban alakult, mint egy holland alapítvány, jelenleg 21 tagország hálózatát tömörítő hálózatok fölötti hálózat, amelyben több mint 200 interdisziplináris matek csoport van benne, ipari kutatói, ipari industrial core teamünk van, amelyet a Siemens vezet, és hát ilyen tagok jellemzik még, mint Michelin, Shell, Bosch, és egy nagyon érdekes, hogy most a svájciak nagyon beaktivizálódtak, a Roche vezetésével csatlakozik, és a Roche behozza Svájc legalábbis tegnap még ezt mondták nekem, én vagyok az HU-MATHS-nek is az elnöke 2020. decemberétől, most intézzük a svájci hálózat felvételét, és egyben néhány ipari banknak, biztosító társaságnak a felvételét. Ők azt mondták, hogy nagyon rövid időn belül svájci nagy bankok és nagy biztosító társaságok is csatlakoznak hozzánk. Miért érdemes ezzel a szervezettel foglalkozni? Két fő tevékenységünk van. Az egyik, hogy egy MSOD-i szolgáltatási egységet fogunk létrehozni egész Európára vonatkozóan. Az MSOD az a modellezés, szimuláció, optimalizáció adatgazdag környezetben, ebből jön össze ez a mozaik szó, és ez az egyik tevékenységünk, a másik pedig az, hogy egy stratégiai kutatási tervet gondozunk, most jelenik meg, én koordináltam ennek az összeszerkesztését, és ez arról szól, hogy az Európai Unió kutatási és innovációs keretprogramját, a Horizont 2020-at, vagy ami majd most lesz aktuális, a Horizont Európa, Horizon Europe, ennek az utóbbinak 100 milliárd euró a költségvetése. Ennek a felhívási szövegeit, a Work programját, azt a technológiai platformok írják. 42 technológiai platform van, az HU-MATHS-in is egy technológiai platform, már elismernek bennünket technológiai platformként. Most 7 szervezettel közösen megalakítottuk a Transcontinuum Initiatívet, amelyben az ETP for HPC, a Big Data Value Association, 5G és a többi nagy digitális platformok közösen lépünk fel, hogy az EU-tól olyan pályázati felhívások érkezzenek, amelynek van matematikai tartalma, amit ők megkövetelnek. Ez egy fő témánk. Ezek a szervezetek, a technológiai platformok, ezek ezt a stratégiai tervüket adják ki, amely tartalmaz olyan use case-eket, amelyek kihívásokat jelentenek a jövőre nézve. Tehát olyan eseteket, amelyekből a jövőre vonatkozóan kutatási felhívásokat lehet megfogalmazni, mivel mi végig Industry and Innovation vagyunk, tehát csak is olyan industrial use cases, amelyek bennünket érdekelnek. Ebbe egyébként a pénzügy is nyilván beletartozik. Ezt a mi stratégiai tervünket, azt már az európai stratégiai tervünket, amely 9 munkacsoportból áll, és van 2 átívelő csoport, mint a Digital Twin, és az Open Euro, tehát valami, hogy is neveztük el? Open MSOD software, vagy valami ilyesmi, tehát hogy egy európai open software parkot hozzunk létre. Ez a 2, majd most fogja a Roche a Computation Biology-t draftolni, de itt ilyen cross-cutting témák, ezek bőven szóba jöhetnek. Tehát ennek a vonala, tehát a lényege még egy mondatban az, hogy olyan partnershipet alakítsunk ki az Európai Bizottsággal, hogy amennyi pénzt a mi ipari partnereink behoznak, annyit vagy annál többet az Európai Bizottság is adjon public funding formájában, és ez a co-programmed és co-funded partnership, ez egy lehetőséget ad arra, hogy egy európai innovációs programot meghirdessen ez a hálózat, ez a technológiai platform, és ezáltal public money jöjjön erre a kutatási területre, illetve óriási nyilvánosság, Európára vonatkozó nyilvánosság. Ezt látja bennünk például a Siemens is, meg a Roche is, és ezért fogunk velük kooperálni. Ez a roadmapünk. A HU-MATS-IN-ben ezeket a folyamatokat szeretnénk leképezni, és jó részt le is képeztük, sőt, sok helyen túl is haladtuk. Legjobb helyekről összeszedtük, hogy ki mihez ért. A németek bizonyos dolgokhoz, a spanyolok a KKV-kkal tudnak jól dolgozni, és így tovább összeszedtük, és ezt a HU-MATS-IN-ból, ebből a FO projektből jó részt megvalósítottuk. A honlapunkon, amely most éppen átalakítás alatt van, ott megtalálható már rengeteg sikertörténet, az, hogy milyen ipari projekteket bonyolítottunk le. Itt van azok cégeknek a listája, akik adtak nekünk támogatólevéllel feladatot arra, hogy célzott alapkutatási projekteket bonyolítsunk le. Ilyen volt például a Márkus Lacinak is egy projektje az NN-nel, azt hiszem, és van, kicsit fű alatt hoztuk be, mert a két fókuszterület ebben a projektben a járműipar volt, meg az egészségipar. Hát egy egészségipari alkalmazása volt az NN-en belül valami egy témának. Lehet, hogy Laci erről majd beszél, úgyhogy erről nem spoilerezek. Tehát ezek a cégek a nagytól a startupokig 50 céggel volt együttműködésünk. Ahhoz, hogy a stratégiai tervünket azt jól össze tudjuk állítani, ezért hát német mintára, hogy a Komzóban csinálják, úgynevezett challenge workshopokat szervezünk. Sajnos most csak online tudjuk, pedig ennek a lényege a networking. Mindjárt a metodológiát azt mutatom, eddig már lement 4, ez az 5. a pénzügyi kockázatmodellezés, és kedden lesz az utolsó a digitális sikrek témakörben. Szegeden volt 2 járvány, vezette, hálózattudomány, az Csendes Tibor és London András vezette, gépi tanulás orvosoknak, Szeged, és így tovább. Ezek voltak Stakiban, Ipar 4.0, tehát ezek a elég jó fellegvárak tartották ezeket a partner találkozókat. Ezeknek a partner találkozóknak, vagy challenge workshopoknak az a lebonyolítása, hogy valaki tart egy összefoglaló előadást, ami a mi esetünkben Laci lesz, Márkus Laci, és ipari szereplők, illetve elmondják, hogy mik a jelenlegi gyakorlatok, milyen kihívásokat látnak ők. Egyetemi kutatók elmondják, bemutatják a módszereket, amiket most alkalmaznak, illetve közösen olyan kihívásokat definiálunk, amelyeket beteszünk a stratégiai tervbe, ami nem egy halott dokumentum csak azért, hogy legyen egy stratégiai tervünk, hanem ez alapján kérünk támogatást megfelelő támogató szervezettől, Magyarországon a Magyar Állam, ITM, NKFIH, arra, hogy európai szinten, meg az Európai Bizottság, hogy ezeket a kutatási kihívásokat, amiket közösen draftoltunk az iparral, ezekre adjon pénzt, hogy ezekre történjen a kutatás. Azért, hogy ezt meg tudjuk fogalmazni, egy kb. 2 oldalas white papert fogunk írni a találkozó után, és ennek a koordinátora, a 2 oldalas white papernek a koordinátora mindig az aktuálisnak a koordinátora, tehát jelen esetben Márkus Laci, és ez belekerül a HU-MATS-IN stratégiai kutatási tervébe, és ez alapján folyamodunk támogatásért. Hogyha az előbb mondta Laci, hogy voltak helyek, ahol a HU-MATS-IN-ről viszonylag keveset tudtak, most csak nagyon röviden a tegnapi teljesen nyilvánosan megtartott megbeszélésen, hogy a stratégiai tervünk hogy fog kinézni, ez alapján én már meg is írtam, és a megfelelő helyre elküldtem, továbbítottam már azt a javaslatunkat, hosszas munka után nem részletezem, de arra jutottunk, hogy a legoptimálisabb a további működése az lenne, hogyha megalakítanánk egy Magyar Ipari Matematikai Non-Profit Kft-t, ami egy mátrix-szerűen fölálló szervezet lenne, és ezek azokat a célokat valósítanák meg, amelyeket elkezdtünk most megvalósítani, tehát ezzel az összefogással létrejönne egy olyan szolgáltató egység az ipar felé, aki bedobálhatja one-stop shop jelleggel a feladatait, és mi meg megkeressük a hálózaton belül, hogy ki ért ehhez a legjobban. A magyarországi egyetemekkel szerződni nagyon nehéz, ezért azt szeretnénk, azért kéne egy független non-profit Kft., hogy ez koordinálja ezeket a tevékenységeket. Ennek kellene egy-két ember, aki állandó az Office-t működteti, a disszeminációt, meg a szerződéskötéseket megcsinálja, és ez működne projektszerűen, tehát nem egy székházat kérünk, mert azt nem kérünk, hanem hogy a most kialakult működés, hogy célzott alapkutatási projekteket tudjunk állami pénzből, ipari igények által definiáltan lefolytatni, létre tudjuk hozni ezeket a one-stop shopot, és mindjárt mutatom, még egy szlájdot megmutatok ebből, de itt az a lényeg, hogy ez a szervezet olyan legyen, amely EU pályázati források elnyerésére törekszik, EU pénzekkel itthon Magyarországon, egy ilyen független non-profit Kft-ben, úgy, hogy meg tudjuk tartani a kutatókat, nem menjenek külföldre, vagy nem menjenek el éppen hozzátok, de igazából ez egy nagyon erős szervezet lehet, ami mindenkinek a hasznára válik, hiszen ez egy nagyon erős együttműködő partner lenne, azok nem hagyja elkalódni esetleg reményünk szerint a fiatal kutatókat, hiszen olyan bért próbálunk már nekik ajánlani, amely már elegendő ahhoz, hogy megtartsuk őket a kutatás, fejlesztés vonalán. És igen, tehát ezeket a szolgáltatásokat, ezekkel a tevékenységekkel próbáljuk beletenni a megalakítandó jogi személynek, amelyeket mondtam, tehát a célzott alapkutatások vitele, one-stop shop szolgáltatások és részvétel európai és más innovációs folyamatokban. Ehhez a Danubia IP, akit felkértünk, hogy erre draftoljon nekünk egy lehetséges megvalósítási módot, elkészítette a javaslatát, ezt fogjuk most tökéletesíteni, és ez az alverzió, hogy legyen egy állami alapítású non-profit Kft. Eredetileg nem így akartuk, hogy állami alapítás legyen, de még ez tűnt a legjobb kompromisszumnak, vagy egy sokkal lájtosabb esetben egy klaszter legyünk, de minden esetre egy szervezettebb formában működjünk, mint ahogy van. Ez a dokumentum már a megfelelő döntéshozók előtt van, hogy ebből valóság váljon, hogy ne egy egyszerű projekt legyünk, hanem egy megalapozott jogi személy, aki le tudja bonyolítani ezeket a folyamatokat. Röviden ennyit, még annyi, hogy a HU-MATHS-inban természetesen minden akadémiai kutatócsoport, aki matekkal foglalkozik, teljesen ingyenesen részt vehet, teljes joggal fölvételét kérheti, a honlapunkon erről információt talál, vagy írjatok nekem, vagy az office@humatsin.hu-ra. Laci, ennyit gondoltam, hogy gyorsan elmondok.
Köszönöm szépen. Remélem, hogy hallható is vagyok. Akkor...
Teljes joggal fölvételét kérheti, a honlapunkon erről információt.
Jó, köszönöm. Nos, kicsit talán most már többen vagyunk, és nehezebb követni, hogy vajon vannak-e külföldi résztvevők. Úgyhogy én az eredeti terveknek megfelelően úgy gondolom, hogy váltsunk nyelvet. Én azt gondolom, hogy ahogy mindenki készült. So, we cannot really follow who are now connected to our conference. So I suggest to change the language to English according to the original plans. And I would like to ask our first speaker, Ákos Ribényi, to present his talk. Well, Ákos, the virtual floor is yours now.
Thank you. First of all, I would like to welcome everybody and thanks for the opportunity. I will try to give a very brief summary about the Matematikai-related topics, issues in the insurance industry, in the most common actuarial work or field where the actuaries are working. So I will try to share my screen if I can. Can you see my screen?
Yes.
Thanks. So just really briefly, so it would be a huge topic, and let me see about the models that the insurance industry typically use. I don't want to talk so much about, there are different models, so my main focus would be the cash flow models, and I don't want to touch that, let's say, catastrophic events models like earthquake or flood or storms and such models like this. It's quite complicated, and typically not all the participant has the appropriate amount of data to build up and maintain such a model. So it's typically maintained by the reinsurance industry, and therefore in Hungary, very few and typically quite limited models are existing as far as I know. But what about the cash flow projection models? These models are common in decades already, so it's not a brand new approach. They try to project the so an insurance policy as a product or one single obligation. It could be covered for a long period of time. Typically, the life insurance business provides products covering for decades in many cases, and those projections and models would like to cover all the entire duration, all the cash flows in and out during this period. Nowadays, also the non-life business started to prepare and maintain such models, because legally they are a one-year contract, but it turned out that one single year couldn't represent properly the whole lifetime, expected lifetime of the product. Such a model seems not so complicated at the first glance, but it's really means some competitive advantage if somebody can establish or maintain a more sophisticated, more precise model, and because it typically used not on the pricing, and it's definitely an advantage if you have a better pricing tool, but also it's applied in many other fields within the insurance industry. And there are a couple of challenges. So there is a lot of data which need as an input for those models, let's say lapse rates, expected claim behavior, so claim ratios or other parameters. And it's not so easy to set up proper models which are has correct run times. I mean, I will talk about the run times a bit later on. But for new products, of course, it's not so obvious which type of data could be used. Let's say a lapse rate from another product can be applied for this new product or not. There is a credibility theory question if we have some experience, but it's not enough, and so on. So the segmentation and the granularity of the assumptions and of course the setup of the whole model, everything can be an interesting question, and to manage those models are really crucial. I mentioned about the runtimes. So the calculation itself is not so complicated. Of course, the interactions and the overall complication might be much higher, but one single policy can be calculated pretty fast. The size of the portfolios, even in Hungary, typically a few 100,000, very rarely a million policy can be projected. It's nowadays it seems also manageable, but if we take into consideration that, for example, to assess the price of the guarantees, let's say an interest guarantee would require stochastic runs to describe all potential future economic scenarios. And let's say 10,000 scenario multiplied by the portfolio number size, it clearly means that we don't have enough computation power to do it. And we have to make some simplifications, and simplifications always has an impact on the accuracy that we can reach. So it's a continuous challenge to maintain and set up more accurate projections which are manageable and could be run in a feasible time. There are some new evolvements. The latest one is the so-called IFRS 17. This is an accounting standard which requires much more calculation. And as it is a very granular reporting requirement, it implicitly means that the accuracy must be increased. So it's again a continuous challenge how we can fulfill all the requirements provided by IFRS 17. As far as I see, it's practically impossible, and nobody can fulfill all the requirements and has to find some compromise where and what kind of simplification must be applied. So it's it provides continuous place for improvements. Solvency II is a bit different topic. It's somehow tried to assess which capital requirements would meet the company. And those assessments are based on the assessment of the extreme events. And everybody knows, I think, that it's extremely hard from mathematical point of view. Let's say here in Hungary, luckily, we don't have so much experience about earthquake, for example, although it must be assessed and especially the impact again, it's really not so easy to say. Even there is a large earthquake, it has a huge difference that the epicenter is somewhere in the Greek plain or at Budapest. So everybody can feel that there is a wide range and very hard to to assess the probability and the possible loss of those events. Although Solvency II is full with the assessment of the extreme events from economical point of view, from catastrophic event point of view, or from insurance portfolio point of view, so mass lapse and how it can react to the economical environment. And there is the second step that so far typically the models mainly were focusing on the so-called liability side, so what can happen on the within the product. But it might have an interaction, and typically for some live products, it clearly has interactions with the asset side as well. And parallel both sides, so modeling both sides parallelly, it's an additional challenge as well, which not so easy to fulfill. So there are a huge number of possibilities when the projections might be improved. I also mentioned that those tools are used for pricing as well, and a player who can identify some important underlying attribute or trigger which might influence the behavior of the risk, and can provide a better pricing model, has a competitive advantage. It's always important how we can identify new trends. Let's say just two examples. If a new road is built, it might influence the traveling habits and pattern, which typically has a consequence on the MTPL, so the motor third party liability prices. And it's not so easy to identify, again, because you might have a huge amount of data, but they are from the past, before this road has been built. Again, how you can timely recognize that there is something new in your data, and how you can consider this information. It's typically not so easy. Another item that at the border, the pendling activity might change, increase, decrease. And especially if the neighboring country has a different pricing level of the how damage of the car can be repaired. So let's say Austria and Hungary, that might again influence the claim that the company should pay out. So again, those changing patterns, to realize those changing patterns is not so easy, but crucial and important. So those were just two examples, and of course new trends arising daily basis. So it's a continuous exercise how we can identify and take them into consideration, and fine-tuning our pricing models. And at the end, I also would like to mention a bit different topic, which are still very important, even at an insurance company. So there are large transaction numbers, and of course, yeah, there might be some fraud because of the nature of those transactions. So I mean claim or commission, but probably we can find some additional topics as well. So to utilizing the big data, artificial intelligence, deep learning, and such kind of new technologies, it might be very interesting, important how we can identify those claims, those fraud events, and prevent them, and how we can react properly on those activities. And I also would like to mention that this deep learning and similar techniques also appeared in the pricing as well. So to especially on the non-life side at this moment. But later on, yeah, everything can be changed and evolved. So that's was in a nutshell what I would like to highlight. And if you have any question, I try to answer.
So thank you very much for your very interesting talk and the broad perspective you gave. We understand that you cannot stay with us until the end of the day and the end of the session. Yes, so I would say exceptionally, I would ask the audience to give questions if they have any. Later on, it will be possible to give questions via the chat window, and I suggest to give the questions during the panel discussion. So now, if you have any questions, please make it. Sorry. I cannot hear any. So if there's no question, at least to the best of my knowledge, and so far as I can hear, if there's no question, then let's move further to our next speaker. And no, I don't really see the program on the screen. So our next speaker is anyway Dávid Bozsó. So I would like to give the floor to him. Dávid, please start your presentation.
Good morning. Just checking if everybody can hear me.
At least I can.
Okay, then at least 1 out of 32. And let me also try to share my screen. That should be it. Okay, there you go. So first of all, I also would like to thank you for the opportunity to present some of the ideas, challenges, topics that I have in mind these days. Maybe before I start, let me give you a very, very short intro. So my name is Dávid Bozsó, and I'm working for NN Group, specifically in the reinsurance entity of NN in the Netherlands for the last almost 7 years now. And currently I'm the CEO of this very nice company and entity. And during my work, I've come across many challenges and many trends and opportunities that I think worth sharing with you. So let's get to it. If I can. It works, great. Or at least I can see now a different slide than previously. So first of all, I think in the previous presentation from Ákos, there were already quite some topics, at least partially mentioned in terms of challenges in the insurance industry. And I also would like to maybe give a little bit different perspective there, mainly coming from a reinsurance point of view and mostly focusing on the business side. And I've collected basically 6 trends that hopefully you can see on the screen that I think pretty much in the minds of everybody these days who works for insurance or reinsurance companies. And I think it's needless to say that the first one is COVID-19. So unfortunately, even this conference, I'm afraid we cannot get past without mentioning this, the current situation or the current pandemic that is ongoing, unfortunately, in our world. Second one is digital transformation. The third one is climate change, and that's a very interesting topic. Fourth one is market turbulence. That is, either something as a result of, for example, the pandemic that we experienced, or could be, some people making comments on Reddit, or it could be, maybe some other people tweeting something. So I think these are all become, the reasons behind market turbulences and market disruptions has become very much widespread and not anymore linked to, let's say, real economic changes, but could be just, change in perception or maybe some very influential people doing something, weird or maybe smart on the social media. The fifth one is cyber risk, and the sixth one is aging population. So I think those are the trends that at least VSNN or VSNNG are concerned with. And I would like to spend a little bit more time elaborating on not necessarily each of those, but at least a few that are I consider the most relevant. And let me start with the COVID-19 pandemic. So I think if you follow how the reinsurance industry develops, I think in order to make the next step in terms of product development and risk that we cover or perils that we consider, unfortunately, most of the time there has to be a shock first, so that the next time then we will not forget about them. And I think many examples, for example, the 9/11 terrorist attack was one of those that was kind of a wake-up call for the industry in terms of accumulation risk, in terms of terrorism risk that might be inherent in some of the policies that have been sold to companies, to individuals. And COVID-19 is also one of those examples that most of the cases, such pandemic or such very severe disturbance to daily life and the daily economy was not considered when underlying policies were sold. And I think some companies did suffer the consequences. And I think some examples you probably remember from the news that I think canceling events like, or postponing at least the events like the Olympics in Tokyo or the Euro 2020 football competition, all kinds of festivals and, big or smaller events. Those were, very much, came as a surprise to many industry players. And because nobody considered that something like that would ever happen, therefore it was not specifically excluded from the policy conditions, nor was it appropriately priced for. So what you see, the first reaction is obviously denial, and the first reaction is that companies try to exclude anything that is related to pandemic. So, for example, they say in the policy conditions that from tomorrow we are not going to cover any negative consequences on any pandemic related or some kind of communicable diseases related risks. And I personally think that this is not necessarily the right answer. But what I think the industry as a whole should do is, in fact, try and find a way to still provide the necessary coverage for events like the COVID-19 pandemic. And that's, I think, what is being addressed on, if you look at the right-hand side of the slide with the third bullet, so insurable or reinsurable. So I think the answer is not to exclude these events, but try to define them in a way and try to price for them in a way that actually can be sustainable for the future. And I think that's where one of the first challenges comes in from pricing point of view and from data gathering point of view of okay, what kind of events we need to consider in this situation. Do we have the data? If we don't have the data, could we create some kind of set of scenarios that are representative enough for a proper pricing exercise? And or are there other ways to actually try to account for such situations that, for example, the COVID-19 pandemic created or has created? So here is really how to price for events that are not necessarily or didn't really happen in the past, but might happen in the future based on events that did happen, and how to create pricing models for those, how to create capital models for those events, and how to define, the boundaries of events that an insurance or a reinsurance company can protect. So what are, the where an event starts, where it ends, and how it can still be considered as a well-priced and properly defined occurrence going forward. So that's around the pandemic. If I move to digital transformation, I don't want to spend too much time on that because I'm not really an expert there. But what I have in mind mostly is, things that are related to artificial intelligence and straight-through processing in an insurance value chain. For example, underwriting of new lives or new risks that are come to, or as a request has come to the reinsurance or the insurance companies. And also on the claims handling side, applying machine learning, artificial intelligence to speed up the process and also make the process hopefully more robust by doing so. So I think I'm sure that there will be other people talking about artificial intelligence, so I don't want to spoil that. So I would like to move to the next one, which is much closer to also my my daily business, and that is climate change. And I think also with the pandemic, maybe climate change has a little bit less focus now, but it doesn't mean that it is less important than it was a year ago. I think it's still one of the biggest problems of the humanity that we will have to solve. And from my experience and perspective, I think climate change, or as it also sometimes referred to as global warming, this has been, a very heavily researched topic, and there are many papers and methods and calculations being done. But I think in order to be very useful for actually an insurance or reinsurance company, it has to be a little bit transformed, and what I call not global warming, but more like local warming. So basically, we have now, I think, more or less adequate understanding of how the global chain reacts to each other in terms of the meteorological chains that circling or Earth. But what is not that well understood, but very important if you provide, for example, car insurance or home insurance, that how these global processes influence your local community. And for that perspective, I think what the challenges and what the problems that we are trying to solve is how to price, for example, or can we price differently in different areas that are much smaller than a country. For example, based on the frequency of occurrence of hailstorms or severe windstorms, rainfalls, or local floods. And all these local elements are obviously the result and the consequence of global warming, but I think they are much less understood. And also locally, there is a huge deviation in terms of what is the frequency, what is the severity of such event happening. And I think that topic and that area is still lacking a little bit of mature research and mathematical modeling in terms of usability for insurance reinsurance pricing and proper risk management applications. Therefore, I think that also this would be on top of my list to mention and give to for you to consider and maybe to think about as one of the interesting topics that have been maybe not as well, haven't been as well researched as the global part of the climate change or the warming side. So that's my take on climate change. If you go to market turbulence, I think that is also a bit of the same element. Also, of course, there are completely different animals, but if you consider also the local element here, so I think, as I said, the market turbulence or the market volatility that is being observed on the market in many markets, many stock exchanges. There is always, of course, an element that is related to the real economy And I think in the past it was mostly, maybe I'm exaggerating, but sufficient to look at interest rates, unemployment, inflation, and maybe bond yields, things like that. So let's say the health check or the sanity checks from the real economy. But unfortunately, these days there are here also local elements. And what I already referred to as local elements, these local disruptions. So, the activist groups on the internet and tweets and I don't know, Instagram stories from people who influence and also who have a lot of money at their disposal. They tend to be able to move the market. And I think understanding the behavior of the market as how they react to these, let's say, local disruptions is also of utmost importance if you're trying to manage market risk and you are trying to make sure that your portfolio is properly hedged. So I think that that's also something that that I would consider as an interesting and very timely topic to be further discussed. The fifth one is cyber risk, and also on cyber risk, I'm not very much an expert, but I think here again, maybe a little bit related and similar to the COVID-19 pandemic. I think what the challenges are is what actually cyber risk is, and what is the type of cyber risk that makes sense to insure, and that makes sense to reinsure. And where does it start? Where does it end? What kind of data that we can gather that is reliable and we can use it for pricing, and what pricing models are appropriate to calculate, a proper risk premium for cyber events. And also there, I think there is still some work to do to make it more, let's say, usable for the industry. And lastly, aging population. So I think also in the Netherlands these days, but in Europe, I think aging population is being addressed via many forums and many different bodies. And I mean here not only longevity, but as a risk, so that the risk of people living longer than expected, but also in terms of opportunities that people live longer, therefore they might need insurance or insurance protection longer than that is commonly provided by the insurance companies, and but for them the need might be different than for example, somebody who is a 25-year-old might have different needs than somebody who's 75, but the need of being insured or being protected is still there. And again, I think the challenge is how to find those boundaries and how to find those products and data that can be properly used to address this, and make sure that for people we can provide insurance even if they are older than the usual population that is being insured currently by insurance products and insurance companies. So yeah, I think that's in a nutshell the few challenges and the few trends that I wanted to highlight, and I thought would be also useful for this forum to consider. And that would be it from my side. Thank you.
Thank you very much indeed for this very interesting insight into the current challenges. So if I understand well, you stay with us for the panel discussion.
Yes.
Let's go then further with the talks and put the questions to the panel discussion section. So I would like to invite now László Martinek with his talk to continue our program. László, this virtual floor is yours now.
Thank you very much, and good morning to everyone. please give me a few seconds to share my screen, which is there are nice options here to share screen. So I believe you can see my screen now shared, but please chip in if this is not the case.
Yes, we see that.
Oh, you can see. Okay, that's wonderful. Thank you. So let me, because it disappeared to me. So let me crack on. So a short introduction about me. I'm László Martinek, head of new business reporting at NN Life and Pensions in Rotterdam. This is a legal entity of NN Group listed on the Euronext. So we came from the same group with David. The theme I would like to talk about today is mainly around longevity risk, which is a quite hot topic these days at the insurance companies and pension providers who are managing large annuity books. And by managing, I mean they need to pay the insured people. They also need to pay the shareholders, so they have to have some cash generation, and at the same time they should not go bankrupt. So with regards to this, we have to manage all these pension books. So if you think about the life expectancy in the world in the past 100 years, that was extraordinary in terms of changes. So today, a child born has a life expectancy of 72 to 73 years, which is still expected to increase by 11 to 12 years by the end of this century. And so if I compare it to myself, I was born in Hungary. When I was born, the life expectancy was 69 years, which is now comparable to Ethiopia today. Well, when my parents were born, the life expectancy was 65 years, which is comparable to Nigeria today. And when my grandparents were born, the life expectancy was around 45 to 50 years, which is now worse than the worst country today, which is the Central African Republic. So I wouldn't even go beyond this time, because you can see how this changes. And so how does it affect the insurance institutions? How does it challenge them? So this kind of trend, there's a huge uncertainty underlying this future mortality trend. So not only the past, but the future. People are expected to be longer in their retirement. I know, so the retirement age is shifting also to the right hand side, but at the same time, people are longer in the retirement. So you can see that there is a shift also from defined benefit products to defined contribution products, and even beyond, there are new products being developed to keep up with these challenges. However, many of these insurance institutions bear a tremendous amount of risk stemming from these liabilities that run off in the next decades very, very slowly. So it's an extremely slow ship, and still we need to do something with this. Normally, so most of the countries, well, many of the countries have three pillars. One is the state pension, one is the occupational pension, and one is the private pension. So we are trying to maintain our lives based on these pillars when we go retire. Well, I know. So when talking about retirement and pension, we are talking about the luxury of our lifetime. So this is something relatively new to humanity in the first place. So at the same time, it's a large risk we have to deal with. Even think about deferred annuities with no immediate payment, and make a small comparison between, say, promising me a lifetime annuity from my retirement until my death, versus paying a lifetime annuity for a person who is retiring right now. So you can see the risk, because me retiring, it will take a long time, and who knows, how all the technology will progress until then. So talking about technology in this respect, I would like to mention one specific thing, which maybe in these days in the presentations you cannot really avoid, which is about COVID-19. So due to this actuality, look at the development of the mRNA vaccines. This is the messenger RNA vaccine. Betting against these developments on the long run, I don't think it would be a good idea. On the short run, you may win by practically shorting the technology, so betting on lower life expectancies. So that can be true, because we can see, well, we can't really see clearly now, but we can see at least that there are higher mortalities going on these days than we expected last year. But I think these are really noises in the system. This is a volatility in the trend. And here is the $1 billion question, or well, I don't know what monetary value Paul Erdős would assign to this. So here is it. How good are we at estimating the future mortalities based on historical trends? So this is something extremely important and extremely difficult. So among the major risks that insurance companies bear, so you can talk about interest rate risk or inflation risk, specifically for inflation-linked annuities. But at least the third one is the longevity risk. So stemming from the misestimation of future mortality evolution, say, underestimating the improvement in future mortalities. So what is the way, and so what is the reason to manage this longevity risk? A bit of a side story. 2 years ago, I attended the fall school of the Hungarian Actuarial Society, and someone from the University College Dublin was talking about investments using historical data, and the actuarial was talking about some new actuarial adventure, namely investing in forests. So you can think of this as the prices of lumber were increasing steadily during the history, and planting trees it takes a really long time. So maybe it would be a good way to match cash flows, but this is not really the way today to hedge or to balance longevity. Today, insurance companies are required to hold a certain amount of capital for bearing this risk. What does it mean? There are different regulations in different countries, but for instance, you might be familiar with Solvency II. The standard formula, if you're using that, is some kind of the capital is some kind of a product of a given percentage, an average mortality rate, an annuity factor, and your best estimate liabilities corresponding to longevity risks. So you can come up with some kind of a formula, standard formula to calculate the capital. But if you think about that, do you think that the one size fits all formula could be really good for the future? Probably that could be challenged. And so if you look at the longevity transfer potential in the world, talking about the US pension funds bear around $15 trillion today, but even the United Kingdom, Australia, Canada, Netherlands, Japan, you name it. So these are all above $1 trillion. So there is an extreme amount of money sitting there, and a liability sitting there. And if there is some kind of progress in mortalities, these liabilities will go up, and they can go up very, very steeply. So how can you, and why to offload longevity risk? So the insurance company might want to balance risk composition, have a better diversification among its no-market and market risks, and on the other hand, use strengthen its capital position. So once you offload your longevity risk, you have an upfront capital benefit, which it can improve your Solvency II ratio. But of course, in exchange for a lower capital generation in the future in Solvency II terms, or say in lower free cash flow generation in the future, you could think of also in IFRS terms as lower operating result in the future. So this is the reason why insurers might want to say offload longevity risk. And why on earth would someone assume longevity risk, so take over the risk? So these are practically, so usually large reinsurers who naturally hedge their mortality exposure, say Munich Re or Swiss Re, Hanover Re, Canada Life. So there are plenty of them with large deals in the past 10 years. The very schematic mechanism of this reinsurance agreement is that there is a fixed leg that the insurer pays to the reinsurance company. So that there is you can see it on the slide. There's a premium plus a fee from the insurance company to the reinsurer, and in exchange there's a floating leg, which is practically the benefit payments, so the annuities that the insurer will pay to the customer. It's a very very simplified version of some kind of a deal, but you can imagine as you pay me, say 100, 90, 80, and so on in the upcoming years, fixed, and I pay you 100 as long as the customers are alive. So there can be, of course, extremes that the customer dies next month, and there will be no. So the insurance company still pays the fixed leg in the very far future, and the reinsurer has to pay nothing. Or the other way around, someone lives 120 years, and there is still a payment going on from the reinsurer in a massive scale. So this is a way of offloading this kind of risk. There is also an alternative. There are many alternative ways, but maybe one dominant one is securitization. So transferring the risk to the capital markets. You can see the example, say Swiss Re set up something similar to cat bonds or insurance-linked securities with a trigger that is defined and at the contract start. So to summarize this, I see there is a huge demand from the insurance sector to really understand and model the future progress in life expectancies, and I see large demand for collaboration between the academia and the industry in the future. I know we are working with lots of compliance related topics as IFRS 17 or Solvency II. These are all important, but I encourage the actuarial society as well to think about these problems actively, and I think these people have the obligation also to communicate with the management how to use data and make business better in the future. I think time is slowly up, so thank you very much for the time. I hope I wasn't on mute so far.
Okay, thank you very much indeed. Yes, we heard a very interesting talk. So again, I would say that the questions we expect in the panel discussion section, I believe you will stay with us, Laszlo. So
yes,
thank you. So now we switch topic in a little bit, although as we saw even in this previous presentation, everything is intertwined in insurance and finance. So, but now our focus will be more on the financial part and the financial mathematics. So I am the next speaker, so I would continue if I can now share my screen. Okay, yeah, seems like I can. it visible, my screen? Oh, thank you very much. So, all right. I should like to talk about some current trends in mathematical risk analysis. Of course, this view is very personal, so it can be challenged, it can be debated. I just should like to focus on certain aspects. If we think about just one single asset and this asset's price, its modeling started very much in 1900 with Louis Bachelier, and he suggested what is essentially the Brownian motion. And then, of course, it was inadequate, and Jimmy Savage caught up the idea and suggested to change it for Paul Samuelson, who actually did it, and considered the geometric Brownian motion, which was a nice model for a long time. Then some other people came, like Bruno Dupier, and they turned to local volatility models because GBM couldn't reproduce the derivative prices. Now, local volatility could, but it couldn't. It didn't work for hedging. So this created the stochastic volatility models, like the Heston model or others. Then again, here rough path theory came into the picture. Then again, stochastic volatility was not sufficient, and then attention turned to exponential Levy processes. Then people still realized that this is also not sufficiently adequate in describing the structure of the stochastic volatility surface. So they introduced the Levy processes intertwined with stochastic volatility. So became complex and even more complex. So question is if there is any need to complexify these models any further. So to answer this, we should think about what is the result of this ever-increasing complexification. As a result, it became very difficult to follow the true model properties, such as, for example, the tails, the extremal behavior of the asset prices, or any, you can think of here other instruments as well. Also, to estimate these models or calibrate became more and more time-consuming. And as a result, the industry in practice often uses simpler, less sophisticated models in order to gain speed in the calibration and meet the demand that the amount of computations represent. So again, not on this line, but on considering more complex products which appeared during the time, they require joint modeling, and joint modeling again becomes more and more complex. Here I think about that you have to jointly model at the same time assets and exchange rates and bond rates, so interest rates, sorry. So these are nested models. These become nested models, and they again complexify computations, increasing the computing times. So should we use even less sophisticated models in the nested model, or should we somehow increase our capacity in computing? So in these nested models, and in many other places, multi-asset options, if we consider them, the basic, one of the basic questions is how to model interdependence. When you have a pool of assets, it is often modeled by a multivariate stochastic differential equation generated from a multidimensional Brownian motion. A multidimensional Brownian motion, coordinate-wise, have a relationship which is described by correlation simply. But correlations can capture linear dependence, first of all, and secondly, they are constant in time. Whereas if you think about dependence, and this dependence is important in modeling CDOs, CVAs, and wrong-way risk in CVAs, quantos, spreads, and the row can be continued endlessly. So dependence is, in general, non-linear, first of all. So that is already something showing the inadequacy of the classical correlations. Dependence is time dependent, so we have to consider a time structure. And just as stochastic volatility came into the picture, dependence, there is evidence for the dependence is can, or at least can be considered random. Now, what kind of answers did mathematics give to these, I would say, questions or inadequacies? Instead of correlations, copulas were introduced. However, this handled the nonlinearity question. However, copulas are still static; they do not have time dependence. Now, dynamic copulas were introduced. One of the researchers well known is Cherubini in this context. They have already temporal structure, however, they are non-random. But there is one serious disadvantage of the copulas. They have one serious disadvantage, that they are not compatible with the SDE modeling. In financial maths, people get accustomed to describe a price evolution by stochastic differential equations. Copulas are not really compatible with stochastic differential equations. There are copula models, but if I show you a simple dynamics, like a first order autoregression generated from T noise, you will get an autocopula, which is just the first leg copula, like this. And this has an S-like shape. If you consider all those copula models, starting from the Gaussian, the T, the Joe copula, the Clayton copula, or whatever, you will never see such an S shape. So, but what I used to tease copula people is this particular example, which I just call the bird copula. Here's a very, very simple dynamics described by two equations, two almost trivial equations containing a square root and nothing, and a product. And this creates this bird copula. So what is this copula like? Is it Archimedean? I'm just kidding, of course. So copulas are not really consistent or compatible, consistent, I would rather say, with dynamics. Whereas in financial mathematics, we get accustomed to describe dynamics. So one of the possibilities to consider the so-called stochastic correlation as a process, a stochastic correlation process I will call it in the next, which means that we create a Brownian motion, we create a process with a multivariate process, if you wish, with Brownian motion marginals, but the joint distributions will not be Gaussian. For this, this can be done by using the quadratic covariation, a non-constant generated quadratic covariation, and this can be fairly easily done relatively, and it will not have a Gaussian copula, because as we learned very well in the previous crisis, that the Gaussian copula doesn't create tail dependence, whereas this one could or can. Sorry. And this process can be used as a driving force in stochastic differential equations. We considered this, and we arrived at conclusions that, for example, using this process in credit value adjustment for assessing wrong way risk, we end up 3 times higher credit value adjustment than what you could get by correlation, by simply using correlations, because of tail dependence. So joint defaults or joint, well, okay, not just defaults, joint problems in a problem. Okay, anyway, well, here in this SCP, a complex correlation process may even have rough paths. Its model is based on a fractional Austin-Uhlenbeck process. However, the problem is again that it is very technical to estimate the model parameters. Usual algorithmic estimations based on, say, maximum likelihood, like MCMC algorithm, are very slow. And therefore, one solution that can be provided is to address these questions or these problems by deep neural networks and artificial intelligence. I should like to mention here a work by Blanka Horvat and her colleagues for estimating stochastic volatility surfaces. They estimated the rough Bergomi and the first factor Bergomi models, and they ended up that compared to Monte Carlo simulations, they could increase the computation speed by roughly 10,000 times. Okay, so that is the way as we should like to proceed on with our stochastic correlation model. We try to apply also deep neural networks. However, we have to change the setup as compared to the previously mentioned work. We have more and different parameters to estimate and different input as well. So this previous approach is not completely suitable. For our first attempt, we use Google developed supported TensorFlow Keras API, and we use the built-in activation functions and optimizers. And it seems to us that we have to go further and create our own ones, because we could not really get very good results. We are working with fully connected convolutional models, but there is still yet a long way to go in precision. If you see here the picture, this clearly shows that we have some progress, but we are still very far from a good estimation. Our next attempt may be a Bayesian neural network. So for the mentioned computational problems, artificial intelligence may give an answer, but its setup is not always straightforward, and we need serious considerations to find the proper setups. But what is beyond AI? Because today AI is everything. It's even in the tap. So it's flowing from the tap. So there is an interesting idea which is probably worth borrowing from the industry, because in industry, digital twins are already considered for a certain time. What does digital twins differ from artificial intelligence? This means that the process in question, which is the production process in the industry, but here we can think about the price, and the production is going on in the market, and the producers are, the operators are the brokers. So they have a permanent sensory feedback. So here we can provide a permanent input to the artificial intelligence system, and this way suggest an interaction for the artificial intelligence for a permanent learning, if you wish. So not pre-learning algorithms, but a permanent learning all during the process. And this way, maybe the efficiency of the artificial intelligence algorithms may be increased. Another interesting field, which is a little bit, I would say, distinct from this, that quantum computing is at the corner, and mathematicians, and in particular certain mathematicians in our HU-MATHS-IN groups, already started to develop quantum computing algorithms, which is yet to apply practically, but certainly it will be a perspective which is very difficult to circumvent in the future. So that was my talk, and I should like to thank your attention very much. Thank you. So still I'm the chair, so I should first of all stop my sharing, and I hope I'm still visible. All right. So let's move to our next speaker. I expect the comments and questions in the panel discussion section as well. So let's move further. We are a little bit behind schedule, so our next talk is the talk of Molnár Sáska Gábor from Morgan Stanley. He's joining us.
Yes.
Well, the floor is yours now.
Okay, thank you very much. Can you hear me?
Oh, fine. Yes.
Okay. So actually, I'm not going to share slides. So I just wanted to talk about modeling and how we see these stuff from the industry. Actually, my talk is going to be interfered with yours, Laci. So it was really interesting to see from your perspective, because there's many overlaps. So first of all, let me introduce myself. So I'm Gábor Molnár Sáska, and I'm heading model risk management in the Budapest office. So I'm with Morgan Stanley for 15 years. So I've been here for a long time, and just wanted to talk a little bit about modeling. So what it means. So how people look at it, what kind of challenges we have, and so on. So first of all, yes. So modeling has been always there in the financial industry. So let's say you had a really nice introduction at the beginning. How different modeling techniques evolved for pricing derivatives, and yeah. So long time ago, that was the main focus. How to find out good methodologies for pricing, and actually that started to change actually. Although how to price derivatives, that has been always a big question, and what are the good models, but actually there are much more today. So let's say so about 10 years ago, actually, even more so that's new types of challenges came across, and one is that as technology has been improving, that there are better technology for computation. Available data so we have much more available data. So these data-driven algorithms started to be more and more important. So e-trading or high frequency trading. So that's really in the hot topic areas at the moment. But so my main direction is not this one actually. So although many companies, a lot of people are working in this area, and that's why methodology, mathematical, statistical techniques, how to use big database, how to find out smart algorithms. That's really very important today. But my talk is mainly about the risk management side. So, and as I mentioned about 10 years ago, so it's been a more and more focus on risk management. And actually, when we talk about risk management, there are multiple levels. So, we can talk about trade level risk management. We can talk about portfolio level risk management, and of course, we need different type of techniques for these risks. So. Just giving a couple of examples what I'm referring to when I'm talking about risk. When we talk about traditional derivative pricing, we are not talking about potential defaults of counterparty. We are not talking about potential inadequate liquidity on the input side and so on. There are a couple of assumptions what we have to use when we are working on traditional models, but they are not there actually in practice. So the question, how to come up with models which can incorporate actually these additional factors. Something new came about 10 years ago, when we had the derivatives, people required additional collateral behind the derivatives, how to incorporate those collaterals. Collaterals could also default and so on. So a lot of additional challenges on top of the traditional derivative pricing. So there was more and more focus on risk management, and you could see that in big companies, risk management departments grew a lot actually. So what are these traditional risk management areas actually? So that's market risk, credit risk, operational risk, liquidity risk. These are different risk types. These departments or risk types are looking for risk from different aspects. Market risk is about what's the impact if any change is happening on the market side, on the credit side. The main question. So what would be the impact on us if a counterparty defaults or our counterparties has some changes in their creditness. Operational risk, in some presentations we already talked about. People talked about cyber attacks, but we can think about reputational risk. So there are many operational risk topics as well. Liquidity risk, that's very self-explanatory. So these are the traditional risk areas actually, and for all of these, the goal is not to reduce the risk. The goal is to understand the risk and manage the risk. And to be able to understand and manage the risk, of course, first you have to quantify the risk, and that's why modeling is really important. Very important to understand what are the good measures, how to quantify these risks in a good way, and how to support the business actually with good risk management. So this risk management evolved actually, and of course, when this modeling happened, there were more and more requirement on that, how to assure that these models are good. And of course, as the number of models has increased dramatically, of course, people working on developing models, and also people checking these models. The number of these people increased as well. But time went on, and additional questions came up, and the next question is, okay, so we understand what this traditional risk means actually. So in every area, so we more or less understand what market risk means. There are well-known models actually in market risk, for example, the value at risk and so on. But the next question is, what could be wrong if there is something wrong with the models? So what is model risk? So there could be a risk in the model as well, and Lazio also had some examples on that. So that's a very interesting and very difficult question. Okay, so when we are modeling something, so whether we incorporate everything what we wanted, and of course, if the model is too complicated, then maybe we are just overkilling something. But we really have to understand so what these models, so how these models can work, and what is our purposes. So actually, model risk management has started to become more and more important actually, and this is really a hot topic even today. So what it means exactly? So what model risk management? So of course we have ideas that there are recent surveys actually, and recent reports by for example consultancy companies trying to figure out what model risk management means. So just to give some highlights. So what I mean on this. So of course, traditionally when someone was a model validator, so what was the traditional task? People had to understand, what was the model designed for. So why people wanted to develop the model. Model validators had to check theoretically from implementation perspective. People had to run appropriate tests, checking whether models are good enough. And if something was not good enough, then people could challenge the developers just to improve the models. But what if all the parties think, okay, so these are the best models we could use? There are still additional questions. So okay, even we think there's no better model today. So what could be the risk actually? So what could happen, for example, if the market environment would change? And there's another focus area actually these days, which is not directly related to model risk management, but related. And that's a stress testing. So firms are asked to do and run appropriate stress testing, which means that we have to prove that we are good even in a different, more stressed environment. But we have to make sure that our models are also working in those environments. So that's so there are and these are interesting questions. So how you can assure that your model is good in every environment, and of course you cannot assure that your model is good in any environment. And the next question, okay, so what's the right measurement? So how to measure what are the good measures to show actually the models are good or not? So these are really hot topics. Model risk management is a focus area, and so what kind of options could we have? So of course we could investigate benchmark models. We could investigate models just changing for example the model parameters, checking how robust the models are. So there are so many type of techniques, but by the end of the day we have to say something whether the model is good or not, or what's the risk behind the models. And interestingly, so there are new techniques in this area, and that's coming with machine learning AI techniques, and that's how I'm interfering Laci's presentation. So the question, we have a model that's working in the current environment, but how to test, whether in different environments it could work, and ML AI techniques could help a lot. Although we also have to be very thoughtful, how to use these AI/ML techniques, because mathematics is only one side of the story. The other one is the business side. So we have to make sure that we are not overkilling these things with mathematics. And if we are talking about something which could be interesting mathematically, but business is too far from that, then we are working on something which is not useful from financial point of view. So these are not easy questions, and just couple of further ideas, how so where we could have these kind of model risk issues. So Laci was talking about the interdependence, or we can talk about hybrid models. When something is so we have a model for one product, we have another model for another product. But what if these products just composing one single big product, make sure these different models we are using for different cases can work together, for example. So there are many cases, and this is really a very hot topic, and there's a lot of mathematical challenges here. So I just wanted to talk about these model risk management involvement and in general modeling. And it doesn't mean that traditional models do not exist. So we still have derivative pricing. We still have new products, new ideas. So the business is evolving. These are just giving additional complexities. And that shows that quant side is getting even more important in the future. Okay, so that's what I wanted to talk about. I don't know whether you have any questions, or maybe we can talk about questions on the panel side.
Yes, our time is rather sharp, so we are a little bit behind schedule. So I would suggest for the questions to put to the panel discussion. So thank you very much for your talk. It was extremely interesting. And now we should like to move further and ask the speaker, who is from BlackRock, and so far as I know, contingently present will talk.
Thank you very much. I hear Seneco. So good afternoon, everyone. I'm Imre Koncz from BlackRock Asset Management Company. I'm doing quantitative research and actually mutual fund assessment with quantitative techniques. And I would like to talk about a little bit what is asset management, highlight some current challenges, maybe some future directions, and how mathematics come to the picture. And I will hand over to István Bara, who will give an example, a concrete mathematical problem, and a way of solution to asset management. So actually, a disclaimer: everything what I'm saying is my own opinion and not necessarily reflect to the opinion or the view of BlackRock. Can you hear me now, everybody? Thank you. So, okay, what is asset management? What is asset investment management? Actually, the main goal is to invest and manage clients' money, client wealth, to achieve their goals. So we can say that the main goal is the return. So you want your wealth to increase, but you also want some risk management. You don't want the risk of drawdowns or volatility, and there can be lots of different purposes. It's related to the clients. So if a client is a pension fund, then the focus is on your liabilities. There are clients like insurance companies, and it's also about longevity risk and other risk. There are other clients like family offices, charities, endowments, banks, and retail banks who want to have a model portfolio which can then distribute amongst individuals. So actually, from mathematical point of view, it's a portfolio construction problem. Portfolio, I mean that you can create a fund from different assets like stocks, bonds, or cash or alternative assets. But also for a big client, you can put together different funds. So it's a little bit portfolio of portfolios. And it's a very complex optimization process with custom goal function, very special constraints, like investment constraints, which is related to the clients, and mathematical difficulties. So you can imagine that the classical methods like Markowitz optimization will not necessarily work in this environment. And I have to mention that it's not a pure mathematical problem. I think it's halfly an art and halfly mathematics. So risk management is very important. I cannot talk too much, but fortunately enough, Gabor already gave a very good picture about how complex is risk management. And what is maybe especially in investment management that you want to be able to explain the source of risk and the source of the return to your clients, both retrospectively and both looking forward. So you want to understand if the return is coming from a good stock picking or good choice of asset classes or good choice of countries, or maybe from FX or from different factors like value factor, momentum factor. I will talk a little bit about that. So this is the most important problems, and your best friend is the very well used and famous factor model. You can see here a stylized explanation. So all the assets, like all the stocks returns, can be explained by some exposure to some so-called factors. So factor can be the market itself, factors can be industries, or factor can be based on some similarities in features of assets, like styles, which can be value, growth, size, momentum, and so on. So at the end of the day, you can have this regression here. So you can explain your risk and returns contribution by factors. And actually the interception, the alpha, means that you generated some extra return which cannot be explained by usual factors. So this is also a big goal in asset management. So you want to give some extra return to the investors. So actually, just about the size of this industry, it's quite big numbers here. So the asset management industry measured in asset under management is about $70 trillion. So 1 trillion is 1,000 billion, or in Hungarian 1,000 milliard. BlackRock is one of the biggest players. The asset under management is approximately $8 trillion. So actually, I would like to highlight some trends, maybe a little bit looking into the future or the current trends. So active versus passive. So active investment is the classical investment when you discretionally pick up your stocks or bonds or whatever and put together and dynamically manage your portfolio. And nowadays, passive investments, which means that you just follow an index, S&P 500 index or Books index, or even following some style factor indexes. Actually, now in the US market, there is more money in passive indices than in active funds. And this is an interesting mathematical question, that where is the convergence? Will passive just take out everything, or there will be a balance or a equilibrium point? What would happen? There are already researches in academia suggesting that as more and more money in passive index following funds, then more instable the rest, because then even small money can move the market or move special stocks a lot. So there is a general trend from fundamental approach to quantitative. I think, of course, there will be always lots of fundamental economist point of view or macro point of view, but it's also a challenge. How can you marry the two approach? It's also a cultural thing and the big mathematical challenge. How can you integrate fundamental views, for example, to quantitative models? There is a big trend to sustainability and so-called ESG, which means that people want to invest their money to green companies or green funds. It's also a challenge to understand how can you incorporate it, for example, a factor model. Is sustainability a new factor, or can it generate alpha at all, or is it a risk factor? So it's a very interesting new direction. It's also a new trend that you can measure sustainability. You can say that actually your investment represent this amount of carbon footprint or this degree of Celsius of global warming. Of course, the industry try to catch up and try to involve as much data science and technology as it can. So machine learning and AI is applied, and it's an open question, what will be the role of Bitcoin or similar coins on the distributed ledger technology. But these are very interesting times. And my last point is that it's also challenging how to model that actually investment has a big influence of the real economy itself. So it's not just that you try to assume that what will be the trend and you invest into it, I think now it's the opposite. It's the other way around. If the biggest players believe that sustainability is a big issue and invest in green companies, then there will be a reallocation of capital, and it will happen. And even if you don't believe it, maybe you need to catch up and you need to invest in green companies as well. So these are the most interesting challenges, I think, in asset management industry. And again, these factor models is very important to fit, to calibrate to data. And I would hand over it to István Barra, who will talk about very interesting problems related to factor models.
Hello, can you hear me?
Yes.
Fine. Yeah. Okay, thank you. Let me share my... Can you see my slides?
Yes, yes.
Okay. So my name is István Barra, and I work at BlackRock in the financial modeling team in the equity risk, on the equity risk models. So as Imre said, the usual disclaimers apply. And today I will talk about covariance matrix forecasting. So covariance matrix forecasting is important because that's the underlying target which we need to be able to forecast risk for portfolios. And also this is what we use as one of the inputs to portfolio optimization. So this is really a core quantity in asset management. And the challenges with covariance matrix forecasting is there are several challenges. So one is that these covariance matrices are really high dimensional. So I mean, we usually talk about in the thousands. So like covariance matrix with 10,000 assets. That's pretty normal, and that poses a lot of challenges in terms of computation. Secondly, covariance matrix is a latent variable, so we only have a noisy measurement of the covariance matrix. We'll talk later like how noisy it is or like what we can do there. But ultimately, we always just have a proxy on the covariance matrix. And this can be challenging because of two reasons. One is that estimation is more problematic because of the noise. And secondly, evaluation of our forecast is also challenging because we don't have an exactly observed quantity to compare with. Thirdly, covariance matrices are time varying and they have certain dynamics and regime switches and things like this, which we have to model. So I included some references which kind of describe these challenges a little bit more detailed. So as Imre already mentioned, in the industry standard to deal with these large covariance matrices is a simple factor model. So you can write it we usually write it on returns, but obviously if you write this structure on the returns, this will imply some structure on the covariance matrix itself. So basically we have the total return or total risk if we talk about the second moment, and we decompose it to a factor part which is driven by common factors, and asset specific part which is specific to the assets. So if you look at it, like you can see that there are kind of 4 important moving parts or parts where modeling is actually can take place. So one is the total return, so the left-hand side, how we measure the left-hand side. Then the factors which we use, then how we model the asset-specific part, and finally, like how can we model the dynamics of all of these. And in the next few slides, I will talk about each of these, and I will go in a structure where I will talk in possible improvements for all of these. And I think improvements can be twofold. One is you can improve on the model by introducing new alternative data, or you can change the methodology or use new techniques. And I will take this kind of structure in the following slides. So let's start with the total return or variance. So when we estimate these factor models, usually we use returns, but an alternative data would be to use high frequency returns and calculate realized volatilities based on those and estimate the model such that we fit these realized volatilities. In calculating, I mean, it's not only the realized volatility which we are interested in, but realized covariance. And here, the new data would be these realized volatilities and realized range, for example. That's another way of dealing with this. And methodological improvements are concentrated on getting more and more efficient estimators of the true underlying realized volatility. And or basically developing methodologies where we make sure that these are robust to jumps and other microstructure noise, which we can observe in high frequency returns. So when we go to these high frequency returns, we increase the number of data points, but these data points also have their own problem because of the microstructure noise and things like this. So we have to deal with these. I mean, there is a large literature on this, but actually getting this to an industry model, that's not done yet. And mostly the issue with these is the computational issues. So you would have to have these realized covariances for all the, for example, 10,000 assets and clean it, deal with it, things like this. So now going to the factors. If you talk about factors, some of the alternative data, which is recently getting some interest, is tax data. One example is that sometimes these, like one of the main, like most important factors in these factor models are the industry factors. And those are 0-1 factors. So basically, you are either in the industry or not. But these sometimes can be actually, it's not true, right? So if you think about Microsoft or Amazon, they have multiple business lines. So it's really hard to put them into one category, right? And here tax data can be helpful because these companies, for example, they have to have these mandatory filings where they describe what they are doing. And you can get this tax data and you can figure out like multiple industry exposures. Another recently getting popular data alternative data is ESG, and as well like climate change data. So here the question is like, we observe the change in climate, which has certain consequences like rising sea level and also hurricanes and things like this. And the question is how these affect the asset prices. In terms of methodology, I just listed few recent methodological improvements from academia. One is the instrumental PCA, which makes it possible to have time-varying exposures modeled. And for machine learning, there are obviously what I showed that those are like, it's a linear factor model, but if you use autoencoders, you can have nonlinear factor model. This is also a new development. And you can also use factor copula models in the factor part. So if we go to the next part, it's about the specific return. So these are or variance, specific variance. So basically, here we talk about asset-specific variance, which cannot be explained by common factors. And in this part, an interesting alternative data again is text data. So you can have a lot of articles, mandatory filings from certain companies, and from this you can figure out sentiment which is specific to the company, and this can help you to forecast the asset specific variance. Another thing which you can get from these text data, connections or networks of companies, so you can figure out which companies are related in a creditor-lender relationship to each other or in supply chain, and you can have a network based on these observations. And in terms of this, obviously needs some newer methodology. So some recent improvements are, for example, spatial factor models, where we use this network to extend the factor model and explain the covariance as a combination of systemic factors and variance coming from these networks or explained by the networks. Another interesting question is that when we talk about these asset-specific risk, it's interesting to think about, I mean, that's a really large, I mean, in the linear factor model, we assume that the specific risk matrix is diagonal, but that's not necessarily true. And if we want to model that, that's getting really problematic. And one way to deal with this is to cluster assets into blocks. But it's not obvious how to do this. So you can do by industry, for example, and you can have this assumption that the specific risks are kind of similar, behave similarly in certain industries. But you can also try to come up with endogenously clusters. And then you can also have all kind of time series methods to forecast the specific risk, the individual specific risk part of the total variance or covariance matrix. And lastly, I mean, we have to deal with dynamics of these quantities. And I mean, the alternative data here is all the previously mentioned. But in terms of methodology, what is interesting is regime switching. So basically, we observe these calm periods followed by some periods with increased volatility. For example, the recent COVID crisis, where volatility shoot up and then it's calmed down. So, like, to be able to capture these regime switching is really important in risk forecasting. And finally, I just wanted to say a few words about what kind of modeling is useful in the industry. So when we talk about like modeling techniques, I mean, these problems, what I showed you, these are like half a century old problems probably. So modeling games probably have diminishing returns. And so this means that probably working on getting new data into these models is much more rewarding. And in general, in industry, usually stability, robustness, and interpretability is valued over really complicated models. And with that, I think I stop here. And not sure if there are questions or we have time for questions.
Okay, thank you very much. Thank you, Dan. Again, I would say that we expect the questions in the panel section, panel discussion section. Let us thank you very much for this very interesting insight. So let us now continue with our program. We are a little bit in delay, but we continue, and our next presentation is coming from City. The two lecturers are Norbert Hari from Budapest, and also joined us from New York, Kumar Ganesh Subramanian. Hello, thank you for coming to us. And please, start your presentation. The floor is yours. Thank you.
Just wanted to give a few words before we start, so I hope you can all hear us. So thanks first of all for inviting, and so we prepared with a specific case and a problem formation, and since this is this idea coming from Kumar, from my colleague in New York, so I propose that he's going to talk about it, and hopefully technically everything is going to work out, because we had some technical difficulties with sharing, but let's see. So yeah, thank you all, and thank you, Kumar. So yeah, so I give you the virtual floor.
Thanks a lot, Norbert. So I'm going to share my screen, and then let's just see if this works out. Can you see my screen?
Oh yes, fine. Yeah.
Yeah, excellent. So today, my name is Kumar, and I work in the Muni Quantitative Analysis group here at City, and specifically, we've been dealing with building pricing models, CVA models for the global spread products business, and the main use case that I wanted to talk about today is about surrogate models in general. So typically, as the previous presenter mentioned, right now the models, the basic modeling frameworks for various products, etc., are all like fairly robust enough, and we have a in our front office valuation, we have a CVA model that works, a pricing model that works, and so on. But right now, with kind of people getting into this large scale data analysis and so on, like a typical use case might be that let's say that I want to analyze my structured notes issuance on a very large basket of underlyings, which in turn would translate as calculating like a XVA charge on a very large, say about 100,000 different non-nettable cross-currency swaps. Now, typically, obviously, valuing an XVA charge on a general particular product is fairly easy. It's just calculating exposures time LGD times the default probability, and that is all our models can do it pretty quickly. Let's say that this would take about a few seconds. But then when you're going to do this for 100,000 different variations, then it becomes very difficult for us to the performance becomes like an issue. And in general, whenever if you're in the business of doing relative value analysis and finding if one thing is better than the other, then in reality we sort of do not really need an accurate answer, but what we need is something that gets us close enough to an accurate answer, but with something that's really fast. So put another way, one way to do this is to basically just think of it like a problem on essentially what I have is I have a massive universe of cross-currency swaps, different coupons, different fixed coupons, different float coupons, different maturities, etc., etc. But each one of them is fairly easy enough for me to price it using my XVA. Now, if I have to calculate the XVA charge on all of this in a fairly quick way, then one way to do it is to basically, instead of pricing all of them one by one, what we can do is we can typically price some set of swaps which kind of span my universe of contracts that I want to that I want to price, and then after that try to interpolate the results by doing Taylor series expansion or something about that space. So that is one way to do it. But then that in itself would, then the next natural problem comes in is that how do you choose these centroids, so to speak? For instance, if you have a massive universe of 100,000 points, then you would need to choose centroids which are function of two things. One is how your input set of contractual data is distributed, and then the other is in terms of how your pricing function typically behaves. Put another way, we can look at this as some sort of convex optimization problem, wherein we would need to find out determine certain centroids, and then after that calculate the width of the the range covered by that particular centroid. It should be as wide as it can get, such that your overall error, if I were to price any contract directly as opposed to doing Taylor series expansion about that centroid, it should be fairly low. So how do you do that, and how do you do that in a way such that it's fast, as in if my entire problem of determining the XVA charges in an optimal way using this interpolation mechanism, it should not be more complex than doing it brute force, which is basically price all of these contracts one by one. So that in a put another way, if you assume that you have a smooth pricing function, then how do you determine a set of grid points on that pricing function such that like you can interpolate any other point fairly quickly without actually having to call the pricing function each time. That is the problem that we are like trying to look to solve. And so there are so obviously there are a few different approaches to look at this. Like one is this centroid based approach that I'm describing, and the advantage of going with this particular approach is that I am effectively building a surrogate model for my product, because I have like an actual model which I know works and works within whatever limitations that is it has been analyzed to death, and that's looking good. And then I'm building like a proxy model for the same product, but these two things converge exactly on these centroids, because I'm calibrating them and I'm pricing the model exactly on my underlying model. So that way it'll give you confidence and interpretability, so that if I were to interpolate based on this grid based on some algorithm, then I'm not going to get results which are totally unexplainable or things like that. Another way to do it is to basically say that you know what, yes, you have a pricing function. Now let's try to train a neural network to this pricing function, and then you have your so you have your inputs as various contractual features, and then I would just calibrate my neural network. I'll train it to such that it exactly reprices all of my a large set of different contracts, and then I'm just directly going to use the neural network for pricing any other arbitrary contract. That also can be considered, but then the only angle is about the interpretability. In terms of we just need to be sure that the result that we get, it behaves exactly like how our underlying pricing model behaves, which we know is arbitrage free and everything. So this is the main problem statement that we are working on. And in general, basically this kind of surrogate modeling techniques are something which we are looking into in great detail, especially in the context of where we would need to price whenever we need to price a large number of similar products using a particular environment. Then these kind of techniques are being sought after. We also have a similar use case. For example, let's say that you are building this. Right now, all the banks are into this FRTB, IMA, and those kind of stuff. And even there, when you're building historical returns for the OAS on a large variety of callable bonds, then you need to find out whether how likely is my bond is to be called within the next 6 months or whatever. And then once again, you have a term structure model that can price these products accurately, but then it's going to take you a while to calibrate it and so on. Then you can probably use the same thing. You can consider the features of the instead of interpolating on the instead of pricing these things one by one, we effectively look to build an interpolating function, which is a function of the features of the product that you're looking to model. And then after that, try to use that to get the results. So that is really the crux of these surrogate modeling techniques. Now, the main mathematical challenge which we are looking to find out is to basically how do you place these centroids? We can obviously use some sort of very naive statistical stuff and then say that I want to place my centroids such that based on the distribution of the data that I have up to the 90th percentile, I'm going to use this particular spacing and so on. So that is one way to do it. But then we have to as enough that would not work very easily if the number of features are becoming very high. So for example, if you're modeling a product whose price depends on say some 5 contractual features, then you need to be very careful about how you put these centroids and so on. So it has to be a combination of how your input data is distributed, as well as how your pricing function behaves in terms of these input data. You potentially want to have like, like the width between these two centroids is a function of like, how linear your underlying pricing function is about these centroids, because like, you're going to put a centroid and then you're going to essentially do like a Taylor series expansion for any other product about this centroid. So obviously it'll work very well if this function is linear in this region and so on. So this is the problem that we are looking to solve. So there are like a few different approaches. Like, one is either directly training a neural network on the pricing function, or, trying to use like some sort of a greedy algorithm to iteratively consider some centroid and then like, try to increase the width and then like try to see how the pricing function behaves and so on. So these are all like, some of the main challenges. So broadly, what I wanted to talk about is that like, there is this concept of surrogate models, which are something that like, we are looking into. And mainly the idea is to basically have your official pricing models do very well, but then these surrogate models can be used for like, doing faster approximations for your official pricing models, which can then have like a variety of use cases. For example, in terms of relative value, or in terms of like, like a data analysis, or even in terms of a real-time risk. Because like, your official pricing models might take like, longer time to calibrate, and like, you have some overnight process, etc. But then like, if I'm able to build these surrogate models, which are like, super quick, then I can basically use these to essentially calculate my risk in real time and so on. And so mainly like, these are the use cases that we are considering. And for these, we are trying to work on various techniques for solving these types of problems. So that is pretty much it. And then like, this is our standard disclaimer about communications and everything. And that's pretty much my my talk. Any questions?
Okay, thank you very much. Norbert, do you want to continue, or?
No, I think this was our problem statement.
Oh yeah, thank you very much. So first my question to the audience, if you have any questions, because probably neither Norbert nor Kumar could join the panel discussions for legal reasons.
We cannot join that now. So
yeah. So are there any questions from the audience? Okay, so probably I don't see any. So I would like to thank again you for your very interesting presentation, and encouraging and showing some possible future research directions. So thank you again. And now I think we should continue our program. Now we have the panel discussion section. So joining us will be Molnár Sáska Gábor, Imre Konc, Dávid Bozsó. Then I'm just checking whether everyone is here. I do not know whether László Martinek is here. And okay, who else? László Kótai, will he join us? He promised to join us, but we cannot hear him. Your microphone is now muted. László Martinek, You're here, but your microphone is still muted. Not now.
Yeah. Yes, I'm here. I'm here. Let's see. I'm just trying to do some can.
Okay. Well, so far we have at least 2, 4 panelists. So my first question would be to the panelists would be that we heard a lot of talks and new challenges, etc. But I would be interested in whether you see any such existing principles that were necessary as yet for a mathematical model to fulfill, but the present situation or just the development of our world overwrote it already, so it is not so much necessary. For example, here I'm thinking about, or I think of a negative interest rate. Okay, so for example, a negative interest rate maybe 10 years ago would be a nonsense for a mathematical model, whereas in our days it's already more or less acceptable if it's not too high. So are there any such principles that are in question now and maybe changed in mathematics? So okay, so let's perhaps start the panel discussion with Imre Kons, if you have any such idea or.
Thank you. It's a good question. So my first note that I used to do derivatives before I joined to BlackRock, and I remember that in the conferences there was like sections to interest rate models which can address negative interest rates. So actually it was interesting because after a few years of negative interest rates, the academics tried to tackle this issue because most of the model just didn't work. Mm-hmm. And they come up with new models. So sometimes these things can actually fuel the research and give new results. Well, it's an interesting question. So as I try to mention in my talk, maybe it's not a principle, but I think usually in finance, you try to anticipate what will happen and then you trade it, like you try to find the best industries or the best companies and you trade accordingly, you sell them, and that will push up the price. And I think this causality on this direction started to be broken down a little bit. So now if lots of investors are committed to something like sustainability, then that can itself change the real world. So maybe it's not perfectly new, but I think it's something I would say something new or something really deep change in finance. That would be my 2 cents.
Yeah, thank you very much, Gabor.
Yes, so actually that's an interesting question, and this is what model risk is about, right? So then when you have a model for something, and but that model has some certain assumptions, and those assumptions could change, and that's happening every day actually. So and that's valid not only in the financial industry, so that's valid everywhere. So model is by definition is we are trying to mimic somehow the world and the real processes, and we really have to find out what are the important factors and what are not important factors, And when we think something is about important, how to model it. So what's the right modeling approach? This is in our everyday life. And as I mentioned, this is one of the main scope of model risk management. Mm-hmm. So just figuring out, where could be the areas where we have to prepare for something like this.
Mm-hmm. Thank you. Okay, just a technical question. I mean, not question, but a note for the technical stuff that László Kótai cannot unmute his microphone. Isn't it possible?
Can you hear me now?
Oh yeah, now we can hear you.
Okay. I logged off and on. Sorry, I lost the several minutes before now.
Oh, I see.
I am here now.
Anyway, from now on, you're on the panel. Could you hear the questions in general? I mean, my question was the first one.
Unfortunately, I missed because I was suffering of fixing my microphone problem.
So it was that. Do you see any existing principles that are regarded as a must in a mathematical model, or were regarded as a must in a mathematical model so far, but the changing environment requires to overstep it and to allow it for a greater whatever variability or whatever. So here I brought the example of the interest rates. 10 years ago, negative interest rates were unexpected for a mathematical model, useful for risk analysis. And in our days, negative interest rates is more or less acceptable if it's not too high, I mean, too negative. So is there anything that you think can be also considered in your field, for example, in the insurance sector that is really drastically changes?
I guess that we all suffering from not seeing the future. Therefore, we build models which use parameters and assumptions and try to do the best. And this is what several minutes ago from Shashka, colleague, that this is the modeling error or the modeling risk, that we do not use the proper model or the proper assumptions. So if the mathematics cannot help us to see the future, the next level can be to help us recognize in due time that the reality diverges from our assumptions. So this could be a big help to build up a good early warning system, for example.
Mm-hmm. All right, so going further to David Bojo, how about you? What could you talk about? What could you say about it?
Yeah, I don't really have a good example, but I think it's not necessarily about models, but I more agree to the thing that, okay, these are more about assumptions and observations that actually comes forward, and then we will have to adjust our reality or modeling reality to what you see. So I think also in my presentation, I try to highlight few of those, like the pandemic, that what kind of probability in the past was assigned to such a pandemic ever occurring and having such a, widespread impact across the world. And you can see what is the probability now. So I think that these kind of radical changes in the observed world really influences, I think, at least the choices of assumptions, and maybe as a next step, to more properly capture these kind of events ever occurring, that will, of course, bring the modeling also forward. But as you said, the negative interest rate. So, I mean, good news is that at least volatility cannot be negative. So, well, or maybe, who knows?
So, Laszlo, Martinek, would you like to add something? He disappeared, or his microphone is muted. In the meanwhile, I should like to encourage the audience to come up with questions if they have any. So I just wonder if someone has a question. It is always possible to write it in the chat window. So perhaps another thing, which is okay in a way, of course, all about the talks, but also the question is what are the fields where the existing techniques seem to be in a way sufficient or already well established and only development is needed, whereas where are the fields where some entirely new approaches are needed. So what is your opinion about? So let's yeah, we have some questions from the audience. I will go to that as well. I don't know, let's see if you could manage the microphone, because it's still muted as far as I see.
You mean mine?
No, I mean Laszlo Martinek. Well, I don't know. Maybe Gabor, you could tell some words about these questions.
So my observation is that we always have new challenges. You know, as time goes on, so every day is new, and that makes our life interesting actually. And being in a quantitative role, being in a place where you have to tackle problems every day, that's pretty interesting. And this is how our life is working. So although we have models and we are using models from the past, but we always have to check whether those models are still good today or whether they could be good in the future. So we can never just sit down and telling that okay, our models are perfect, we don't have to care about them. So every day new challenges, new developments. So that's my view on that.
David, any comment?
No, I can only agree. So I mean that modeling is never ready, hopefully. I mean, if it is ready, then it means that you have reached a steady state and nothing ever will develop further. But I mean, luckily that's not the case. And again, if you see new events occurring, if you see, I don't know, a huge ship crossing the Suez Canal, I mean, those are all observations that not necessarily are part of your pricing models. And that means that, your pricing model can be made. And if you see these things, then that also tells you that, you cannot really rest. And there is always something more that you need to incorporate.
Thank you. Imre, any ideas?
Yes, I have just one idea. So in my experience, I think that there is lots of focus on, for example, derivative pricing, asset pricing, risk modeling. I have an impression that, for example, maybe there should be more focus on to investigate the systematic stability of the global economic system. Let's think about flash crashes. So how stable is the exchange auction system, for example, or high frequency trading. So I think that area is maybe not discovered enough because every industry player just focus on their own tasks, which are challenging, but I think we maybe don't know enough about how economy or how the global financial system works. Mm-hmm. It can be a provocative sentence, so maybe I have to get feedback that do you think it's true or not at all?
Yeah. Well, perhaps in line with that note, I may ask, so do you see any role in mathematics in order to detect the changes that the circumstances in the circumstances where all these models are created or set or applied? So whether mathematics should develop special tools or apply more efficiently its tools to really detect the changes when those happening in the environment. And for example, okay, let's say about insurance, the insurance sector, that the change of claim frequency, claim size, or mortality rate. So whether those are sufficiently, is it possible to detect them sufficiently quickly and well by the current mathematical tools, or should it have more focus on that? Kotai, Laszlo, I don't know whether you have something to say, but I think your previous remark was somehow also related to this one.
Yeah. My problem is with our projections and models, that we build up extremely complex models and projecting 100 years cash flows. And a big question can be what precision we require from these models. Is it worth to build in the last small option of an insurance policy in our models versus keeping the simplicity, or adding a new feature or modeling a new feature may not improve the precision of our models, maybe improves the error of the model. So in this respect, I cannot see what mathematics to add it. Maybe the break-even point where we do not have to further improve the model with additional features. There was a question.
Yeah, thank you.
Okay.
Laci, Martinek, any notes or any remarks, or to any of the further future, previous questions, because now I see that you came back with your microphone. Do you have anything to say? Laci, Martinek, Laci. I think probably he has a problem with this connection. Probably.
Yeah.
Oh, yeah.
Yeah. Thank you. I'm not even sure if you can hear me because I have some connection problems. But to just one thought to the latter one, if I heard it correctly. Mm-hmm. So understanding understanding the shifts in either mortalities, morbidities, or lapses with respect to insurance contracts is quite crucial in setting correct assumptions either for price. So I think we still need to, the whole industry still needs to work on this, how to measure these in a correct from a theoretical perspective, but also to set up the systems fully appropriate to these changes. It also comes with some compliance. So the IFRS 17 regulations, where the granularity of all these changes you have to show is very smooth. So it's a matter of how can we allocate resources to these works, because I see there is still a lot to do.
Well, thank you. Well, I see we have a question from the audience by Honor Gabor. He says, by further development of risk management, will we ever be in a situation when future crises can be anticipated and thus mitigated and thus avoided? Or will we always be responding to past crises? Well, yeah, that's a good question, in fact. So, David, perhaps maybe you can say something for us.
That's a great question. I think if you go back again, the pandemic, the recent pandemic, I think it's not that nobody saw this coming, right? So I mean, if you look at research papers and risk analysis from the World Bank and from big reinsurance companies, etc., then you see that this kind of pandemic has always been on the list as something that might occur. But obviously, the probability of occurring and the consequences were potentially not fully foreseen. So I think that, in my personal view, I think future crises can be anticipated, but and maybe mitigated. But I think just having the proper risk management and models will never be enough to have them completely avoided. Because I think for that you need also political and economical power to do so, and the will to also make the necessary changes and sacrifices to actually avoid this crisis, unless, of course, it is taken seriously. So I think that I believe that we have, the models, the risk management framework, the risk analysis that I think many companies do are well suited to come up with risks that are evolving or present, but and therefore we can anticipate them, and maybe the companies themselves may be able to mitigate some of the impacts, but to have them completely avoided that are on a global scale, I have my doubts.
Gabor, how do you react to
this? I fully agree. So that's exactly what I wanted to say.
Yeah, it's easy to understand. Imre, any thoughts?
Yes, I think this is a very interesting point. So I heard it in the risk conference that if we calibrate our risk models to the past few crises, then it's a guarantee that the next crisis will be very different from them. And I think it's a really bit related to model risk. And if everybody uses the same risk model, which is calibrated to the Lehman crisis, then the people will take positions which are not sensitive to the Lehman type of crisis, but maybe more sensitive something what we never seen. So I think it can be a systematic risk itself.
No, I see. László Koltai?
My feeling is that it is the nature of the crisis that we cannot foresee them. If we could foresee them, then we would build up walls to protect us. So we rather learn from the past crisis and we prepare for the coming of something similar. But as you said, the next crisis would be completely different. We build up indicators that shows that, well, the volatility is so high that 2 days before the last crisis it was a bit lower, and 2 days after the crisis didn't come. So we tried to forecast based on indicators, based on the words of gurus, but no one can predict the time and size of the next crisis.
All right, so I think our time is well over because we are well behind schedule, but even we are approaching 2 o'clock, so probably a lot of us have other duties. So, so I would like to thank all the speakers of today's meeting and all the panelists, all the audience for the interest and for asking questions. And well, I'm very happy that this event was possible to made, which needed some efforts from the company's side because of some confidentialities that we had to overcome. And well, we hope that we really will be able to take the benefits of this discussions and incorporate these new challenges and the necessary the elaboration of the necessary means into our mathematical program or mathematical or future projects. And I hope very much that it will be in the benefit of all of us. So thank you again for being with us. And this is then the end of our session or conference today. Thank you.
Thank you very much.
Thank you.
Okay, thank you.
For organizing.
Bye.
Thank you very much. Goodbye. Bye.
Bye.
Oké. Ezzel az utolsó szekciónk is véget ért a partner találkozóval. Talán ez volt a leglátogatottabb része az egész konferenciának. Köszönjük a szervezőknek és az előadóknak a részvételt. Ezzel a 3 napos HU-MATHS-IN Konferencia 2021 rendezvényt befejeztük, az előadásokat megtartottuk. Sok fontos dologba döntöttünk, hogy lépjünk tovább, akár a stratégiai tervvel kapcsolatban, akár csak idézőjelben mondva a szakmai kollaborációk indultak a szünetekben, a megbeszélésben. Sajnos ez nem valódi megbeszélés volt, hanem ilyen, de szerencsére a Maxwell rendszer segítségével ezt tudtuk élhetőbbé tenni ezt a helyzetet, és külön köszönöm Sudár Annának és minden szervezőnek a közreműködését, technikusnak, hogy ezt a rendezvényt nekünk a HU-MATHS-IN számára megtartották. Köszönöm a munkatársaimnak is a közreműködést, a HU-MATHS-IN Office-nak, Várhidi Renátának és Papné Narcisznak a közreműködést a rendezvény megtartásában, valamint minden HU-MATHS-IN tagnak, minden előadónak. Ezzel a rendezvényt bezárom, és aki figyel minket, nekik jó hétvégét kívánok. Viszontlátásra a következő rendezvényünkön.